What's up? I'm Russ of the world famous Dapper Dividend's YouTube channel, and we're discussing 5 quality dividend growth stocks for beginners, or anyone really. Now, they have 2 things in common that I screened for: easy to understand business, and they're really good at making money, with 5-year average returns on capital of at least 20%. Return on capital employed, or ROCE, which we'll call ROCE, tells us how efficiently a company makes money. For example, Nike's 22.8% ROCE means they generate about 23 cents in operating profit for every dollar they invest in their business. And seeing this above 20% for 5 or more years is a strong sign of a quality company. But as I learned the hard way beginning in 2018, finding great companies is just the starting point. And I know some of you are going to scrub through the chapters just to get the stock tickers, so knock yourself out. But stick around, because I'm going to show you why even great looking companies can have some warning signs that the market is trying to tell us about in their dividends. And do remember that I am just an amateur investor sharing my passion for passive income, so this is really just for fun and entertainment. Hey, and I also have a free weekly newsletter sharing my unique thoughts and weekly portfolio activity, and the link for that is in the description below, as well as a Seeking Alpha affiliate offer where you can save a few bucks. Since starting dividend investing, I've learned that the first step is to find those companies that can consistently make really good returns on their capital. But dividend investors, especially those of the dividend growth investing variety like myself, really have to pay attention to how much money the company has to pay out those dividends. All right, company number 1, Nike, ticker NKE. They are the most recognizable athletic brand in the world. They make money primarily through athletic shoes. Think about how many pairs of Nikes you see every day. Go ahead, look at people's feet. They won't mind. They also sell apparel and accessories under Nike, Jordan, and Converse brands, and they spend a whole heck of a lot of money on athlete endorsements, which of course helps maintain their brand power. Now, Nike has a dividend safety score according to Simply Safe Dividends, where we're looking at this, and hey, you can get a free 2-week trial by just giving these guys your email address. So check it out. Go a little bit more in depth because we're going to move quick through these. But Nike has a dividend safety score of 99, very safe. They have a very strong credit rating of AA-, which is like getting an A on your financial report card. And check this number out. They have a beta of 1.01. And what a beta of 1.01 means is that if the market goes up $1, Nike will go up about $1.01. So it's pretty much going to move historically in line with the market. But if the market goes down $1, Nike's going to go down about $1.01. They've paid an uninterrupted dividend for 40 years. They've been growing that dividend for 22 straight years. And over the last 20 years, they've grown that dividend on average of about 15% per year, which is really quick. So I told you it's going to be quick. So the last metric we're going to look at, and again, this is just showing you that Nike of a free cash flow payout ratio, because the dividend is paid out from the free cash flow, which is why I like to use that more. Earnings per share, which you see over here to the left, and the earnings per share payout ratio, it can be a little bit more financially manipulated, but hey, if you want to manipulate free cash flow, people are probably going to risk going to jail. So I like this number. It gives me the warm and fuzzies a little bit more. And Nike's last 12 months, the LTM, free cash flow payout ratio was 41%. So they have enough free cash flow to cover their dividend. And again, they have that 22.8% ROCE, which shows that they are very efficient at turning investments into profit. And that dividend yield of 2.19% might seem a little bit low, but it tells me that the market isn't really too concerned about Nike being able to maintain that dividend. And hey, they grow it pretty quickly. And I think there's exciting times ahead for them with their new CEO. Well, kind of new. He spent 32 years with the company, starting out as an intern in 1988, Elliott Hill. I think he's going to do much better than the industry outsider John Donahoe. So I think exciting and better times are ahead for Nike, although it could be a little bit choppy sailing until things do improve. Number 2, Expeditors, ticker EXPD, and they are in my neck of the woods. They're basically the behind-the-scenes player that keeps global trade moving. They're a logistics company operating in over 100 countries, helping businesses move products worldwide through air and ocean freight, customs brokerage, and warehousing. It's probably best to think of them as the company that makes sure your online orders can come from anywhere in the world. They don't own the ships or the planes. They're more like the smart coordinators, which means less capital intensity. And they also have that pristine dividend safety score of 99, very safe. Current yield also kind of lowish, but as you'll see, they grow it very quickly of 1.30%. Simply Safe doesn't have a credit rating for them, and I couldn't handily find it. So, hey, you're going to have to do some digging if you want to pull it up. Like Nike, they have a last 20-year compound annual growth rate of 15%, although they did raise it 5.8% in May of 2024. So, might be slowing down just a little bit, but they've been growing that dividend for 29 straight years. They too have a very low free cash flow payout ratio of 34% last 12 months. And if they make more money, which you look down here at the free cash flow per share, when that goes up, the free cash flow payout ratio drops. But either way, they're easily able to cover that dividend from their free cash flow. And this boring but beautiful business that just keeps executing year after year has an impressive 42.3% ROCE, which is the highest of the ones we're going to look at today. In the number 3 spot, you got D.R. Horton, ticker DHI, which is America's largest home builder operating in 30 plus states. And they do everything from buying the land and building the homes to helping with mortgages and insurance. They focus on different price points from starter homes to luxury, which gives them flexibility in different market conditions. And they've even expanded into rental properties, which adds yet another income stream. They also are continuing the trend of very safe safety scores, 85, very safe, credit rating of BBB+, which is moderately strong, and a beta of 1.77. So remember, on average, historically, if the market goes up $1, D.R. Horton's going up about $1.77. Market drops $1, it's going to drop about $1.77. Well, all that means is that stock price is a little bit more volatile than the market, but if you're investing for long term, then hey, maybe on the downswing, you can get some cheaper shares. D.R. Horton has a last 20-year CAGR of 9%, but remember, this encompasses the great financial crisis where that dividend got cut and it was flat for several years. But lately, just like in October of 2024, they raised that sucker 33%, and the dividend is way, way above where it was when they started cutting, where it was right around 60 cents a share annually, and now we're up over $1.20 a share. So home builders, from what I understand, are pretty cyclical, and there you go. In 2021, their free cash flow per share dropped to just 74 cents, which put their free cash flow payout ratio at 108%. So that was kind of coming out of the black swan event of the COVID crash. But lately, 15% last 12 months, just a very, very low. Gives them plenty of cushion and lots of room for dividend growth. So even though that 1.25% dividend yield looks a little bit low, once again, it's probably going to be growing pretty quickly in the near future. Especially if we got all these golden mortgages like mine at 2.25%. We ain't giving that up. Lots of people are just going to be married to that mortgage, so we're going to have to build new homes to get people owning homes, right? And D.R. Horton has a very nice ROCE, 5-year average of 27.7%, showing that they are very efficient with their capital. Number 4, Best Buy, ticker BBY. Hey, we all know Best Buy, right? Where many of us went for CDs, but it seems today they're all about renting out space to brands through a store within a store concept. This allows brands to showcase their products in a branded space, and Best Buy benefits from the rent and sales. So they've also built a strong service business with the Geek Squad and warranty programs, but they do face challenges from fierce online competition and how electronics retail can be cyclical. Now, Best Buy doesn't have that very safe score, dividend safety score of 60, borderline safe. They also have a BBB+ plus credit rating, which they show is moderately strong. Higher dividend yield of 4.22%, and I'm going to show you why in just a second here, and a beta of 1.43, so it's a little bit more volatile than the average market move. Best Buy has a last 20-year CAGR of 18%, very fast 5-year CAGR, but that last dividend raise in February of 2024 was only 2.2%, but they have grown that dividend for 20 straight years. But their free cash flow per share really has dropped since coming out of the pandemic, and that has pushed that dividend to over 100% in 2024, but they can sustain it for a little bit, and as we see, it's starting to come back down, that free cash flow payout ratio, covering the dividend now, so you're going to want to keep an eye on that. But the market is saying, hey, we're at 78%, and historically, you can see that they were mostly below 40%, so the market's saying a little bit of a red flag here, and we're going to need to be compensated with a bit of a higher yield in order to take on the risk of investing in Best Buy. So while that free cash flow payout ratio over 100% is a big red flag, the ROCE of 31.2% average over the last 5 years is just outstanding. And it's a perfect example of why high yields can be a warning sign, and the market again saying, hey, we need more compensation for the risk we're taking over here. Number 5, Papa John's, ticker PZZA, which Papa John's is interesting because it is primarily a franchise business, and it makes money from franchise fees rather than owning all the restaurants itself. Now, it should be a capital light business model, but there's a few red flags. And I also want to let you know that as of today's recording, there was some recent news of a takeover to privatize Papa John's from a Qatari investment group that saw the stock shoot up almost 20%. Now, for Papa John's, we can all understand the pizza business. They have a very fast last 10-year CAGR of 22%, 5-year of 14%, but they are in jeopardy of losing the dividend streak. They have not raised it since August of 23. They have a dividend growth streak of 3 years, and they're about running out of room. From the way I understand it, if they have one more quarter without a raise, they're going to lose that streak. So watch out for Papa John's. They've had problems with the free cash flow per share. So again, you can't just look at one metric. As we see a bunch of cyclicality, they had free cash flow per share declining from 2015 all the way to 2019. Everybody's at home for COVID then. We're ordering pizzas and it shot up and then it's dropping off again, which has pushed that free cash flow payout ratio in 2019 to 203%, 139% in 22, and 122% the last 12 months. I would be very, very cautious about Papa John's, but they may be going private, so we're going to have to see what happens with that. But in the meanwhile, you're getting that dividend of almost 4%, and they do have that ROCE 5-year average of 27%. Oh, and I did forget to mention that their credit rating is BB-. So now that I think about this more, I'm like, why the heck are they on this list? So there you go. You have 4 quality dividend stocks to consider, and one got some red flags on it and got a little bit of hair and stink on this one, which is probably why they have that dividend safety score of 50, borderline safe. So tread with caution, you pizza-loving people. I hope that by now you know a few things to look for beyond just that dividend yield number, and that the market is pretty good at pricing in risk. So when you see an unusually high dividend yield, there's usually a reason, and it's time to start investigating and figure out why. Now, in this floating little box next to my head, I shared a particular dividend growth stock that beats 92% of the pros. So, hey, if you want to find out what stock it is, I would recommend clicking this little floating box next to my head, and I'll tell you which one it is there.